If you've ever seen those grim financial headlines, or maybe logged into your investment account only to see, well, everything bathed in red, you know that feeling, right? That
Yeah,
knot in your stomach, maybe even a bit of panic.
definitely.
But what if that instinct, I mean, it's natural, but what if it's actually pointing towards a hidden opportunity?
Right.
This deep dive is basically your shortcut to navigating those, let's say, challenging waters, turning what feels like a crisis into a real chance to build wealth. So our mission today, unpack some powerful strategies for investing when things feel volatile. We've pulled together, a stack of fascinating sources, insights from legends like Warren Buffett, practical advice from pros.
Mhm.
Get ready to maybe shift how you look at market turbulence.
It's so true. Market volatility, yeah, it's deeply uncomfortable. Feels like a punch to the gut sometimes, frankly.
Yeah.
But it's actually, a normal part of investing. Expected, even.
Yeah.
Your gut might scream sell, but history shows something pretty stubborn.
Mm.
Markets, well, they always recover. The real insight isn't if they will, it's how that recovery creates the opportunity you're looking for. So the challenge, it isn't just the numbers, it's cultivating what our sources call a strong heart when you're facing that fear.
And that brings us right to the core problem, doesn't it? That natural human reaction, fear, when stock prices tumble.
Yeah.
You've probably felt it, right? That not wanting to just sell everything, run for cover. It's a completely normal, almost like automatic response.
And that's precisely why getting that market ups and downs are normal is so, so critical. Instead of seeing dips as this terrifying cliff edge,
Mm-hmm.
the material we looked at invites us to see them more like, say, the tide. It goes out, sure, but it always comes back in.
Right. Reveals things on the shore.
Exactly. New opportunities for those patient enough, or maybe those brave enough to dive in. Like, think about this analogy from the sources. You buy a house, $2 million. Next day, someone offers $1.5 million.
You wouldn't sell.
Of course not. You know the underlying value hasn't just vanished overnight. Stocks, surprisingly similar. The fundamental value might be totally fine even if the market price dips for a bit.
Okay, that sounds simple, but seeing those red numbers, it's visceral for most people. So
Mm.
how did the sources say we actually do that? Bridge the gap between knowing the value is there and resisting that urge to panic when the price drops.
Well, the research gives some concrete actions. First, pause. Just breathe deeply. Then check the information critically. Ask yourself, is this drop just, short-term noise? Or is it a real long-term problem for the company?
Okay,
Second, go back to why you bought it, your original reasons. If the company's fundamentals are still strong, the business is sound, well, then there's probably no logical reason to sell.
makes sense.
And finally, be really careful about rumors, social media. That stuff can just amplify fear and lead to, frankly, poor impulsive decisions. Herd mentality.
That emotional discipline, it really ties into that famous Warren Buffett quote, doesn't it? Be fearful when others are greedy and greedy when others are fearful. It seems almost counterintuitive, but our sources really dig into why it's not just a clever saying. It's like a deep truth for investing. When others panic sell, they're basically creating these incredible buying opportunities for people who are prepared, disciplined, able to see past the noise. It's about building that strong heart we mentioned, seeing beyond the immediate fear.
Okay, so if taming emotions is step one, what about the actual moves? What can we do when the market's on a wild ride? The sources lay out some really powerful, time-tested strategies.
Right. The first one, maybe the most fundamental, is diversification. Think of it not just as a safety net, but like your portfolio's secret weapon against volatility.
Okay.
By spreading investments across different assets, different industries, you avoid those heavy losses if one area tanks. It really helps reduce that long-term volatility, makes the ride feel, well, smoother.
And the numbers really make that clear. Imagine you have, say, 100,000 THB.
Right.
Put it all in one stock fund. It drops 10%. You've lost 10,000 THD.
Yeah. But what if that same 100K was diversified? Like 50% stocks, 26% bonds, 24% mixed fund. Stock fund still loses 10%, okay, but maybe the mixed fund gains 10%, bond fund stays flat, your total loss, only 2,600 THB.
Huge difference.
It's dramatic, all from just spreading the bets.
Exactly. That example really shows the power of distributing risk, and the material details the different asset classes you can use. Domestic stocks for growth, though higher volatility. Bonds, usually more stable, lower volatility. Short-term stuff like money market funds, safer havens, International stocks can give you broader opportunities, but they come with their own risks too.
Now, here's where it gets interesting. A nuance from Buffett himself. Don't over-diversify.
Right.
He suggests, yes, spread your investments, but holding too many stocks, maybe 20, 30, up to 60 companies, might mean you don't really understand each one deeply.
Product's spread too thin.
Exactly. And Buffett, I mean, he's diversified, but famously has like 40% of his portfolio in just one stock, Apple. It highlights knowing and really believing in the quality you hold.
And to balance that, CNME, another investor we looked at, offers a practical approach for managing risk more broadly, like maintaining a balanced allocation, maybe 50-50 between Thai and foreign stocks.
Ah.
It helps ensure you're participating in different market cycles, not putting all your eggs in one geographic basket, so to speak.
Okay, but for a lot of listeners, maybe the idea of constantly timing the market, it just feels overwhelming.
Yeah, it does for most people.
Is there a simpler way, a more systematic approach the sources recommend? Especially for someone just, dipping their toes in or who wants a more hands-off strategy?
Absolutely. And this brings us to dollar cost averaging,
Good.
DCA. It's actually elegantly simple.
Okay.
You invest a fixed amount of money, regular intervals, say every month, and you do it regardless of the asset's price at that moment.
So you don't worry if it's high or low that day.
Exactly. The core idea is averaging out your purchase cost over time. Price goes up, you buy fewer shares. Price goes down, you buy more. It takes the guesswork, the emotion out of market timing. You're just consistently buying over the long haul.
And that has some really compelling advantages, right? Especially for new investors. Reduces risk from volatility because you're not dumping all your cash in at a peak.
Right.
Helps diversify risk over time, not just assets. Great for beginners or anyone who doesn't want to become a market analyst. And crucially, it builds that investment discipline.
Like an automated workout plan.
Totally. No excuses, just showing up financially every month. It really echoes that Buffett long-term view, doesn't it? If you're not ready to hold for 10 years.
Don't hold it for 10 minutes. Yeah. DCA embodies that patience. Building wealth brick by brick, even when it's stormy out there. Now, DCA is powerful, but you do need to be aware of potential downsides. You might miss out on some gains in a really strong bull market if you're only putting in fixed amounts slowly.
Right, you're not going all in quickly.
And it is a long-term strategy. No quick returns here. And, this is critical, if you pick the wrong asset for DCA, something that just fundamentally declines over time. Well, even DCA won't save you from losses. The asset choice still matters a lot.
So if you're thinking, okay, DCA sounds good, the material gives some steps to start. First, define your goals, your timeline. What's the money for? When do you need it?
Crucial first step.
Second, set your regular amount and frequency. Third, pick the right assets, maybe broad mutual funds, solid stocks. Fourth, choose a platform, ideally one that automates the DCA for you.
Makes it easy.
And finally, just remember to check in periodically. Monitor your results. It's a marathon, not a sprint, after all. Okay, so beyond just managing risk, what if you could actually generate income, like consistent income, even when the market's doing its roller coaster thing?
Yeah, steady cash flow.
That's where the sources point towards dividend stocks. This is where it gets really interesting for income seekers.
Right. Dividend stocks are simply shares in companies that regularly pay out a slice of their profits to shareholders. Usually quarterly, sometimes annually.
Cash in hand.
Exactly. It can be a fantastic form of passive income. Gives you tangible returns, even if the stock price itself isn't exactly soaring at that moment.
And the benefits seem pretty clear. You get consistent income, which is great anytime, but especially when things are choppy.
Definitely a buffer.
Yeah, that buffer against volatility. The dividends can help offset price drops. Plus, good long-term total returns, you get the dividend income and potential stock price growth.
Best of both worlds, potentially.
And if companies keep increasing those dividends, it can help fight inflation. And maybe the most powerful part, reinvesting those dividends, that's where the compounding effect really kicks in, right?
Oh, absolutely. Your money starts earning returns on its own returns. It just accelerates wealth building over time, almost automatically. Now, when you're picking quality dividend stocks, the sources say look beyond just the yield percentage. You want a consistent payment history. Do they keep paying even during downturns? That shows strength.
Okay.
Strong profits, consistent earnings growth, that's what funds the dividends. A healthy balance sheet, low debt-to-equity ratio is key too. High debt can put future payouts at risk.
Makes sense. Look under the hood.
Exactly. And dive into metrics like price-to-book value, PBV. A low PBV. That might signal a bargain, a company the market is maybe undervaluing.
Oh, interesting.
And while a high dividend yield looks good, also check the beta. A low beta suggests the stock is less volatile than the overall market. It doesn't zig and zag quite so dramatically. That adds stability to your income stream.
So you can see why dividend stocks are particularly compelling in bear markets. They give you that consistent cash flow,
Tangible return.
even when prices are falling. And that gives you great opportunities to reinvest those dividends at lower prices, buying more shares cheaply. It just accelerates the long-term compounding.
Like getting a discount on future wealth.
Yeah, it helps that investment heart grow stronger, even during the downswings. So, bringing it all together, what does this mean for building a really robust investment approach, especially when times feel uncertain? The sources offer some incredible wisdom from giants like Warren Buffett and CME that kind of underpins all these strategies.
Yeah, Buffett, for instance, timeless insights, he always says. Invest in what you know. Avoid stuff you don't truly understand. Ignorance, he thinks, is riskier than the investment itself.
Good point.
And maybe his best advice, invest in yourself.
Yeah.
Develop your skills. Keep learning. Take care of your well-being. That's the foundation for everything else.
The ultimate investment.
Absolutely. And he hammers home the long-term view. Again, that 10-year rule. His holdings in Coke sees candies for decades. That proves it. And finally, understanding price versus value. The stock price jumps around daily, right? Market moves.
Constantly.
But the underlying value, the business's future cash flow, that might not change nearly as much. Focus on the quality of the business, not just the ticker.
And building on that, CME offers some really specific advice for today's world. He suggests looking for companies that can grow even if populations decline, thinking about those big demographic shifts.
Forward-looking.
Yeah. Prioritize global companies, worldwide potential, not just domestic. Capture broader opportunities. And this is really insightful. Choose companies where the executives are in the same boat as investors.
Aligned incentives.
Exactly. Their success is tied to shareholder success, a real partnership.
And CME really reinforces something critical, bringing us back to the start. Never, ever sell out of pure emotion unless you have a better plan for that money.
Where is it going next?
Exactly. The goal, he stresses, is building that long-term portfolio with a competitive advantage, not just reacting to market noise. If you don't know the next move, maybe holding tight and letting that strong heart guide you is the better play.
So as we wrap up this deep dive, I think the key takeaways are pretty clear. Market volatility. It isn't necessarily a signal to panic. It's more like an invitation to find opportunity. By mastering your emotions, diversifying strategically, embracing that consistent power of DCA, focusing on quality, especially those dividend payers, you can navigate the downturns and actually build significant wealth over the long haul.
Yeah, and the sources consistently suggest that in the stock market, which can often feel tumultuous, it's the strongest heart that survives.
Yeah.
And that's not just about financial strength, right? It's mental fortitude.
Resilient.
Exactly. So maybe the ultimate investment isn't just in stocks or bonds, but in cultivating that internal discipline, that perspective to see opportunity where almost everyone else just sees fear. So it's something to reflect on. Think about your own emotional responses to market news. How can you strengthen your investment heart and really embrace that long-term journey, seeing volatility not as a threat, but maybe as a stepping stone?